Dear students, welcome back. We are in the fifth session of our first chapter, an overview of financial system under financial institutions and regulatory bodies. In the fifth session, we are going to concentrate on financial institutions of non-banking nature. So we have already learnt about different institutions which are working in banking capacity. In this session, let us see the various financial institutions which work on non-banking principles. Non-banking financial companies are also regarded as non-depository institutions. The NBFC, non-banking financial companies, are establishments that provide financial services and banking facilities without meeting the legal definition of a bank. So as we say that banking institutions are regulated by the Banking Regulation Act, these NBFCs do not come under banking regulation since they are not covered under the definition of a bank. Non-depository intermediaries don't take deposits. Instead, they perform other financial services and collect fees for them as their primary means of business. So for any activity performed, they need to have a return which is regarded as fees for non-banking financial companies. Different types of non-depository intermediaries. So first one, insurance companies. Insurance companies specialize in writing contracts to protect their policyholders from the risk of financial losses and associated with particular events. So insurance companies provides different policies to cover the risk of different nature. For example, like medical insurance, vehicle insurance, road insurance, accidental insurance, and so on. So they collect the nominal fees in the name of insurance premium, and that will be used for covering the risk which will be repaid in the name of insurance amount in the event of any risk occurring. Insurance companies collect premiums from policyholders which the companies then invest to obtain the funds necessary to pay the claims to policyholders and to cover their other costs. Second one, trust companies or pension funds. These companies take contributions from people and promise in return to provide future income. Pension funds invest contributions from workers and firms in stocks, bonds, and mortgages to earn the money necessary to pay pension payments when contributors retire. So these companies work mainly on the funds available for post retirement or post work period funds. Third one, brokerage houses. A brokerage firm or simply brokerage is a financial institution that facilitates the buying and selling of financial securities between a buyer and a seller. Brokers are people who execute orders to buy and sell stocks and other securities. They are paid commissions for their services. So brokerage firms are specialized in carrying on the agency work between the two parties, wherein the two parties are made to come together, complete the transaction and close the transaction successfully with the interference of brokerage houses, since they take care of all the transactionary procedures. Loan companies. Loan companies, sometimes called as finance companies, are not the banks exactly. They do not receive deposits and they should not be confused with banks. Savings and loan associations are the credit unions. They are only private companies that lend money and make a profit on the interest. To offset the risk, these companies charge a higher rate of interest but provide quick access to funds to their customers. So, wherein banks, a lot of official procedures are involved, whereas in these loan companies, which are not exactly defined banking institution, they are going to simplify the procedure, but the only thing is that they're going to charge with a higher rates of interest as compared to the proper banking institution. Currency exchanges. Currency exchanges, they do not make loans or receive deposits. They are the private companies that cash the checks, sell money orders, or perform other exchange services. So, since the business institutions have n number of expanded activities, some of their activities are outsourced even to these currency exchanges. They charge a fee, usually a percentage of the amount exchanged. These currency exchanges are available in the airports and other travel and tourist destinations. So that's the reason that it becomes easier for the business institutions to approach currency exchanges rather than directly deal with the exchange transactions. Mutual funds. A mutual fund is a type of professionally managed collective investment vehicle that pools money from many investors to purchase securities. So, this will enable bringing down small nominal savings and making larger investments in securities. A mutual fund obtains money by selling shares to investors and then invests the money in various equities and bonds, typically charging a small management fee for its services and sharing the returns with the investors. So, just as a banking institution is going to perform the activities, so is the mutual funds are also performing by channelizing the savings into investments. At the same time, they have also proved very profitable and successful. Hedge the funds. Hedge funds are not considered a type of mutual fund but are similar to mutual funds in that they accept money from investors and use the funds to buy a portfolio of assets. Since the business organizations will also have a certain amount of debt capital, they can use the same for investing and making additional returns on it. So these funds can be used by the hedge funds wherein they're going to manage for each individual company on their specific requirements of period of investment and return on investment. Hedge funds are often open-ended and allow additions or withdrawals by their investors. So the money invested is not a locked-up capital. They can withdraw at the time of the need. Lastly, investment banks. An investment bank is a financial institution that assists individuals, corporations, and governments in raising capital by underwriting and or acting as the client's agents in the insurance of securities. Investment banks concentrate on providing advice to firms issuing stocks and bonds or considering mergers with other firms. So these being an extended activity, so this can be easily taken up by an outsourced firm, that is our investment banks. So whenever an institution or organization is established for carrying on a professional or a specific activity, they become more professional and enhanced in their area of knowledge. So this is going to yield both the investment banks as well as for the business or organizations which are going to approach them for carrying on their business activities. So this was a brief note on the non-banking institutions. Thank you so much. Let us meet again in the next session.